Welcome back to the Video CPA. I'm Michael Scott. I'm your host for this channel. And sorry I haven't been with you the last 2 weeks. I came down with COVID, and so I've been suffering from COVID, trying to get over that for the last 2 weeks. But anyway, I'm back, and today we're going to talk about deducting auto expense, which is in some ways one of the more difficult areas of the tax law, because there's a lot of rules around it, and especially if you're a tax preparer preparing a tax return, it's just hard to get from your client what you need to deduct auto expense and do it properly. So this is kind of a sticky area, so I thought I'd talk about it a little bit and let you know things that you need to do to appropriately deduct your auto expense if you can at all. So let's go ahead and into it. You see our disclaimers here. So what are the requirements for deducting auto expense? You know, some people think that if they, buy a new car and put a fancy sign on it that's got their name and the name of their business on it, that makes it a business auto. But it doesn't. I mean, the only thing that makes it a business auto is being used in business. So you can do anything you want from an image standpoint, but you've got to use that auto, or that car, that truck in business before it's considered a business expense. Okay. So even your business might buy the auto, and the business might own it instead of you personally, but it's still not a business auto unless you're using it in business. So that's the main thing. I mean, is it used in business? Okay. Now, there are uses where they're not business uses. We're not going to talk about those, but there are areas where you can deduct auto expense, and that would be medical and charitable. And of course, if you got a rental, you can do it for rental purposes as well. But so those are usually taken on a standard mileage rate basis, and we'll talk about the standard mileage rate a little later. But if you've actually got a Schedule C business or a corporation or a partnership, whatever the case might be, you've got to look at that business usage. And generally, you don't take 100% of the automobile. I mean, the IRS isn't stupid, and they know you're not driving that automobile 100% for business. There might be some situations where a client does do that, but they've got to be very meticulous in making that happen. So your business percentage has to be figured out on a business automobile, and that business percentage is actually your business miles driven during the year divided by your total miles driven by the year for the year, and that gives you what your business percentage is. And so if that percentage comes out to be 70%, for example, you take 70% of your automobile expenses. So, but in this area, I can't stress enough that you've got to have documentation. If you show up to a audit, for example, of your books, and you don't have good documentation, and it should be a contemporaneous log, if you don't have good documentation, you are going to lose every time. That's been my experience with audits. So generally, my clients that I've taken into an audit will have a mileage log. So just remember that without documentation, you're going to lose all your mileage expense, and some of this stuff adds up to quite a bit of money. So make sure you've got good documentation. You can show that it's contemporaneous is best. I mean, if you just show the dates where you were on the calendar and go back and rebuild your mileage log, that might be acceptable. But contemporaneous, meaning it's done at the time, it's recorded and at the time that you made the trip, is what's best. Okay, let's push on now. Two methods to deduct automobile expense. One is the actual expense method, and the other is the standard mileage method. So, if you don't drive your car much, the actual expense method is going to be best for you. But if you are putting on high mileage on the car, 50,000 miles a year, your standard mileage rate is probably going to be best. So you have to look at what fits. But I see both of them being used, and I can't say that one is used more than the other. The standard mileage rate is certainly easier, but in both these cases, you've got to keep that mileage log again. So we're going to talk about the actual expense method first, and then we'll go into the standard mileage method and just kind of compare the two. So let's get with it. All right, some of the things that you can write off if you're using the actual expense method, it is what it says it is. It's your actual expenses. All right, so some of those actual expenses might be oil and gasoline, repairs, maintenance on the car, registration fees, insurance. If you've got a lease, it would be your lease payments, depreciation expense, interest expense, parking and tolls, and property taxes, that type of thing. And there are other things that might come in there as well, but those are some of the more common expenses that you take off when you are writing off a car in the actual expense method. Now what this means is you've got to keep not only mileage logs so that you can show your business percentage on this car, but you've also got to keep receipts on all this stuff. And I'll tell you, I've had clients that have brought me in their oil and gasoline receipts all stuffed in a shoebox for the whole year, and it's a pain in the butt to go through. So you're better off if you don't pay as much, if you can summarize all these stuff yourself in different categories. But the actual expense method is a good method. Like I say, if you're not driving your car much, not putting a lot of miles on it, it works very well. And but you do have to discipline yourself to keep your expenses, your copies of your receipts, and to keep your mileage divided between business and personal, and so that you can come up with that business use percentage. All right, let's look at the depreciation part of this actual expense method, because depreciation is a little bit more difficult for people to handle. And depreciation is taken if you take the actual expense method. It's really taken under the standard mileage method too, but you don't see it because it's built into the standard mileage rate. Okay, so just be aware that you are getting a depreciation deduction as part of that standard mileage rate. But if you're not taking the standard mileage record, then method, well then the depreciation has to be calculated. So elements of that depreciation calculation, the purchase price of the vehicle. Usually that starts with the vehicle invoice, the dealer invoice that you have. And then you've got to figure out a useful life of the vehicle. That's pretty much defined these days by the IRS. Got to figure out a depreciation method, which is also defined by the IRS that you use. Business use percentage, that's the percentage I've been talking about. That's why you keep your business miles versus your total miles on the vehicle. And then we've got this thing called annual IRS deduction limitations. So the IRS, under different circumstances, allows you to write off more on certain vehicles than on other vehicles. Okay, so on what's called a heavy vehicle, which is over 6,000 pounds, you can write off that entire vehicle in the first year. So because it's limited to the vehicle cost. Now I have a truck, a Chevrolet 2500 that is a little bit over 6,000 pounds, and so that could have been written off. It's an old truck now, and so I didn't mess with it, but and I wasn't using it for business. But you get one of these big trucks and you're over 6,000 pounds, where most passenger vehicles are not. Certainly something like an Excursion or a Suburban or something like that may well be over 6,000 pounds. But so these are passenger vehicles that we're talking about over 6,000 pounds. Now, if they're under 6,000 pounds, you are limited, so you can write off If you include bonus for the first year, you can write off up to $18,100 per year in the first year of depreciation. That's a lot of depreciation, but vehicles are costing a lot these days. So, second year 16,100, third year 9,700, fourth year 5,760, and fifth year 5,760, and there's probably nothing left after that. So just be aware that there are limitation deductions on your car under the actual expense method when you're writing off your vehicles for depreciation purposes. All right, let's look at the standard mileage method then. Standard mileage method, you're just applying a rate to your miles, to your business miles, okay? So that means if you've got 20,000 business miles, you apply a rate to that 20,000 business miles, and that rate changes every year, but currently it's about 56 cents a mile, all right? So on 20,000 business miles, you're getting a write-off real quick. You can figure it out of over $10,000 a year on that vehicle, so which is a pretty good write-off. But there are a few things with the standard mileage rate method that you can take in addition to your calculated standard mileage deduction. So you've got things that are included in that rate, and then you've got things that aren't included that can be added in. And so it's good to be aware of these things. So things that are included in the standard mileage rate are depreciation, lease payments, maintenance and repairs, gas, insurance, registration fees, that type of thing. Those things are all included in that standard mileage rate. That's why that standard mileage rate is higher than what you would sometimes think that it should be. But and then there are expenses that can be deducted in addition to the standard mileage rate, and they include your interest that you're paying on the car, your personal property taxes that you pay on the car, and then your parking fees and tolls. So if you have any of those, you can add those in. If you're taking the standard mileage rate, you can still take those actual expenses of interest, property taxes, parking fees, and tolls, okay? In order to take standard mileage rate, it's got to be done in the first year the vehicle is put in service. Okay, so that's the standard mileage rate, and so these things. I mean, there is a lot in this area of vehicles, and that's why vehicles are pretty difficult to account for, actually, for a tax preparer anyway, because they just can't seem to get all the information. I mean, generally, when if you're a tax preparer and you have somebody give you their taxes, well, by and large, they don't give you the mileage on the automobile, and if they do, they give you the total mileage and not the business miles. So, so then you got to go back and ask for it, and sometimes. They've changed automobiles, and you don't know which automobile they're dealing with. So automobiles are kind of a moving target, but they can be kept up with if you if you're pretty conscientious about keeping track of them. Now, one other thing that we had, if the business owns the car, for example, and there's personal use on that car by one of the employees, or one of the owners of the company, well, then we used to send out a letter at year end with our firm saying, hey, if you used your business car for personal purposes, we have to give you some income from that. Okay, so we would have to actually compute some income on that business portion of that, or that personal portion of that car, and then they would have to report that in their Form 1040, and that's the way that is supposed to happen. But so be aware of that, whether the business owns the car, whether the person owns the car. If the individual owns the car, well, he's just taking the business portion of it as a write-off. If the business owns the car, well, then if the person is driving it for personal purposes. So he's got to pick up some income off that car. So, all right. That's what I've got for you right now. If you got any questions on this, just leave them in the comments section. I'll try to answer them. I'm a little bit behind on my responses because I have had COVID, but I'll get caught up. So anyway, appreciate you watching. If you haven't subscribed yet, please do so, and I'll be back with you soon.